can get underway. So welcome everyone to LPC's first quarterly market update for 2026. Bit of background about LPC. LPC is an independent tenant advisory firm with 6 offices across Australia and New Zealand, and we are dedicated to representing occupiers in all aspects of commercial real estate and achieving tenant-friendly outcomes. We've observed over the years that most of the market commentary tends to reflect the landlord's point of view. In contrast, today's session is designed specifically for tenants. Our team of experts will provide a high-level overview of the Q4 2025 conditions across the office, retail, and industrial sectors throughout ANZ. And as always, this will be through the lens of the tenant. So joining me today, we'll have Graham discussing office, Adrian retail, Ken industrial. Gillian will be providing statistical analysis about the vacancy and occupancy in each sector, and Rebecca will be at the end touching on circular fit outs. So we'll start off with the office, retail, then industrial, and then we'll have a discussion about circular fit outs, and then there's a Q&A at the end. Please feel free to ask questions throughout and we can get to them at the end. Thanks. So how we normally get started is I'll provide a couple of key insights we're seeing across Australia and New Zealand on each of the sectors. So firstly, with office, work from home arrangements and entitlements an ongoing issue globally. Locally, there was a recent decision by the Fair Work Commission that found an employer's direction to return to work at the office was lawful, despite his contract granting him the right to work from home. This decision is now subject to an appeal. In retail sector, there's been a number of high-profile shopping centre transactions highlighting the value landlords are generating for investors. However, this comes at the expense of tenants, reflected in higher rents and reduced incentive levels. Adrian will provide further insight in the retail section. On the industrial front, AI and data centres have emerged as a new class of industrial asset, attracting significant investment. However, given these facilities are highly specialised, purpose-built, and typically pre-committed, they do little to alleviate the broader supply constraints facing tenants, particularly in a sector that we already know has low vacancy. Ken will cover the strategies for navigating the industrial market section in his section. So starting off, we'll have the office market snapshot. We'll have an overview of the vacancy data, the market status, and then the tenant perspective.
Okay, thanks, Ed. So Australia's national office vacancy rate has risen slightly over the past 6 months, increasing from 15.2% to 15.9% as of January 2026. This has been driven largely by the completion of new buildings across the major office markets. Non-CBD locations saw a sharper rise in vacancy, moving from 17.3% to 18.5%. Perth and Canberra stood out as the only CBD markets to record a decline in vacancy. Melbourne continues to lead the country in vacancy, increasing from 17.8% to 19%, reflecting the ongoing impacts of the extended pandemic lockdowns. Looking to Brisbane, we expect a significant slowdown in new office developments over the next 3 years. Combined with the continued tenant demand, vacancy is forecast to trend down. Across New Zealand, we've also seen increases in vacancy rates across the 3 major cities. And in Sydney also edged higher to 13.8%, despite clear signs of improving demand. Over to you, Graham.
Thanks, Gillian. As Gillian was sort of pointing out, these figures are demonstrating that the market is still tenant-friendly in a lot of cases, but what we're likely to see is some tightening of vacancies across all markets, which will mean there's going to be upward pressure on rents and downward pressure on the incentives. Throughout our presentation today, you'll see this barometer where we look at the lease norms, the state of the market in terms of where they sit in terms of cost, risk, flexibility, obligations and guarantees, and whether they're sitting in the tenant-unfriendly, landlord-friendly side of the equation. And our job then is to push them into the tenant-friendly side of the equation. And we'll give you an update of where we see each of the markets sitting. So from an office perspective right now, I'd say we're still sitting in a tenant-friendly market across most of Australia and New Zealand. But watch this space. It may start to move back to a balanced and potentially tenant unfriendly market over coming years. So the trends that we're seeing across the board, and they're fairly consistent nationally, is the continuation of the flight to quality. Tenants are prioritising amenity, ESG credentials, wellness features. In one report I read the other day, they're saying that the tenant experience and their staff experience is probably one of the biggest criteria that tenants are looking at when they're considering alternatives in the market. It's important to understand opportunities to secure high quality space and having regard to lease expiries and business requirements, particularly with forecasts showing that tightening vacancy across all markets, particularly in those higher grades. When we look at rents, it's critical. It's a critical metric, but you really need to, again, look at that effective rent, not just the face rent. It really does come down to that's the number that you're really paying as a cost to the business. Incentives typically remain high in all markets. And interestingly, again, a report I read yesterday mentioned that there's some real changes where whilst the pressure is on the rents increasing, there's not as much pressure on bringing down the incentive levels. Landlords are pushing face rent in the first response to a tightening market. Investor sentiment remains, I suppose, it's soft, but it's improving. We've seen certainly increases in confidence in markets like Sydney, Brisbane to a lesser extent, and the expectation is we're going to see capital flowing back into these assets across the country over the course of the year in 2026. Sustainability and ESG are now a core business requirement, especially for companies working with large corporates. Tenants are increasingly selecting buildings where the landlords work with them in terms of providing the information and data that they need to meet their sustainability targets and their sustainability reporting requirements. Looking ahead, I've said vacancy is expected to start the decline. It'll be a case of how rapid those declines are across the market. That's being driven predominantly by the end of the supply cycle or the slowing down of those cycles in different markets. Markets like Perth have no new supply underway. And I read one forecaster saying that the vacancy could be as low as 5% within 5 years. So it leaves a fairly clear message. Now is the time to move in markets like that and lock in. So from that perspective, we look at the LPC strategies and the tenant outcomes that we look to achieve on all of those in terms of your portfolio optimization, lease management, lease restructuring. And the critical ones I've highlighted here is your lease restructuring before expiry. Given that we're going into a market now where it's going to start to move more towards a landlord-friendly environment, my advice is if you've got upcoming lease expiry, move sooner rather than later. And even if you haven't got a lease expiry, any time is a good time to reconsider your lease, talk to even existing landlords about restructuring, extending leases in return for more favourable terms now, and locking in the benefits that you would achieve today.
Perfect. Thanks, Graham. Moving now on to the retail section. We'll have a look at the leasing trends, then large format, then the shopping centre, and then CBD. And then we'll have a look at the tenant perspective. But first, here's Gillian with the trends.
Thanks, Ed. So Australia's retail market continues to deliver a mixed picture with performance varying by sector. Large format retail and shopping centres are showing improving fundamentals with vacancy trending down. That's being driven by limited new supply and steady tenant demand. Other retail segments are stable, however, outcomes differ by submarket, with higher vacancy emerging in certain locations. On the rental side, effective rents remain under upward pressure. In many markets, we're seeing face rents increase alongside the reduction in incentives, which reflects ongoing demand for well-located, high-quality space. And finally, we're starting to see CPI edge higher again, and this will flow through to tenants via annual rent reviews, adding further pressure to occupancy costs. Over to Adrian.
Thanks, Gillian. So as Graham highlighted the barometers within the office market, lease norms in the retail sector remain largely unfavourable, driven by landlords' strong supply side power, knowledge and information of the market that single retailers just don't have access to then utilise in their favour. Market conditions vary significantly, as Julian said, across the categories, and in theory, they should favour tenants in the current climate of challenges with cost of living pressures. However, many landlords continue to overlook the external pressures tenants face beyond their lease obligations. Rather than acknowledging these challenges, landlords are prioritising their own financial outcomes, ensuring they remain insulated from broader market conditions. With the retail sector under the strain of the cost of living pressures and now rising interest rates, a more supportive and collaborative approach from landlords would help sustain tenants and foster long-term relationships rather than compounding existing pressures. Move on to the next slide. So large format retail. Whilst retail spending increased by 10.1% year on year for household goods in November on the back of strong Black Friday sales periods, the latest interest rate rise will continue to place pressure on those large format retailers experiencing modest retail sales. Meanwhile, a shortage of available properties in the large format sector continues to increase face rents, with net rents below $300 a square metre becoming increasingly rare. New developments are limited, and searching for new locations can often take 6 to 12 months, with quality existing stock difficult to secure. Large format retail is also becoming much more considered in their decision-making process, which is increasing the time to conclude negotiations across the board. Those retailers who can move quickly to secure internal approvals will be in a position to benefit from securing sites in tightly held markets. While most landlords are open to offering incentives on new sites, there has been a reduction in capital contributions for fit-out works, particularly amongst private or small landlords. Renewal incentives are almost non-existent due to rising borrowing costs, and expertise is required to extract as much value as possible from the negotiation. Moving on to shopping centres, so retailing remains challenging within the centres as vacancies, especially in the regional, super-regional and sub-regional centres, are becoming limited. Whilst rents continue to increase, retailers are facing pressure from wage growth as well as the rising costs from the households. In an ABS report this week, living costs for household rose by 2.3 to 4.2% in the December 25 quarter. These challenges, along with longer and more discount periods, are having a negative effect on profit margins. Ensuring that supply chains are working effectively is also a challenge. A number of retailers we work with are experiencing delays in stock arriving, as well as having the right stock for the right season. The US tariff situation continues to make retail challenging as well, with retailers exporting to the US, incurring additional costs, as well as being forced to consider different export markets. All of these issues make it extremely difficult to incorporate rent increases and maintain long-term sustainable retail businesses, especially with shopping centre landlords still seeking increases on renewal by 5 to 20%, along with fit-out upgrades. Tenants in larger shopping centres continue to be affected by relocations on renewal as the landlords prioritise maximising turnover and rental growth by revisiting tenancy mixes and introducing new brands. As we discussed with large format, landlords are only providing incentives on new sites, and even then the amounts are reduced or reflected within a higher face rental. With CBD, vacancy rates are slowly starting to decrease after a sharp rise during and after the COVID period. Positive trend within Sydney, Melbourne and Brisbane has been the investment in the metro train systems, with increased foot traffic in Brisbane and Sydney having a positive effect. Melbourne is now finally also enjoying the benefits, along with additional retail precincts opening in and around the new stations. Suburban retail negotiations remain difficult for smaller tenants, as many landlords are reluctant to acknowledge their obligations when not in their favour, or they push back on accepting terms that are not the norm. In a recent negotiation that we had in Adelaide, the landlord was not prepared to accept the market review provision with incentives being taken into account. Even though this is an acceptable position for a tenant, because it was not mandated under the Retail and Commercial Leases Act, the landlord was not prepared to negotiate on this point. With new sites, retailers continue to be highly selective when evaluating the new sites. With rising fit-out costs and ongoing economic uncertainty, tenants are prioritising locations that meet all operational needs, particularly exposure, signage and parking. Secondary sites that may have been acceptable pre-COVID are no longer being considered. So just touching on the tenant's perspective, there are a number of strategies that a tenant can enact to receive favourable outcomes within the retail sector. In orange, we have highlighted competition with other tenants that has relevance to the slide shown. As discussed earlier, the landlords often hold the power of information in negotiations. So if this is the case, speak with your other tenants in the shopping centre or strip to gain insights into what terms they have in place and what challenges they might be facing. You can then utilise this information in your negotiation. Thank you, and I'll hand over to Ken.
Thanks, Adrian.
Yep.
I'll just jump in quickly. So industrial market snapshots up next with Ken. Again, Gillian will give us an overview of the stats. We'll look at the current status, the trends, and then the tenant perspective. Thanks, Gillian.
Thanks, Ed. So if we look across both Australia and New Zealand, industrial vacancy rates remain stable. However, they continue to sit at historically low levels, driven by limited new supply and the ongoing absorption of space. This tightness is most evident in key freight and logistics corridors, where demand for big box distribution and last mile facilities remains strong. While some markets have experienced modest increases in vacancy as new developments come online, overall availability is still well below long-term averages. As a result, limited supply continues to support rental growth with upward pressure on rents and fewer incentives, particularly for modern, well-located industrial facilities. I'll now pass over to Ken.
Thanks, Gillian. As Graham mentioned, we'll also touch on where this sits in terms of the tenant norms. The Australian industrial market has remained structurally landlord favoured over an extended period of time. That's supported by long-term demand fundamentals and constrained growth. Whilst conditions are beginning to normalise with demand moderating and new supply entering the markets, these shifts have not materially altered the balance of power in most locations. Tenant leverage remains limited, particularly for well-located, high-quality assets. Above all, the success of the outcome will really depend on timing, recognising when market conditions create windows of opportunity and taking action to do so. On the next page, we'll explore some practical strategies designed to help tenants regain power and create more balanced, tenant-friendly outcomes. Industrial rents have increased materially over the last 3 to 4 years, which is underpinned by demand and limited land and increased construction costs. Whilst headline rents remain at historic high levels, rent growth has clearly moderated across most markets as supply is delivered in 2025 and occupier decision-making has become more cost-conscious. Landlords are increasingly using incentives and deal flexibility, whether it's rent-free periods, fit-out contribution, to secure tenants, whilst trying to maintain face rents. That said, conditions remain highly precinct-specific in tightly held submarkets, particularly infill and last-mile location. Rents remain high in some locations, with incentives limited, reflecting the scarcity of prime or premium grade stock. ESG considerations are now becoming a core requirement rather than a point of difference for many occupiers. In particular, for global organisations, sustainability mandates are now prioritised assets with recognised environmental credentials such as the Green Star or NABERS, supported by other building features such as solar, EV charging, and water efficient design. Transport, postal, and distribution centres continue to dominate demand nationally, supported by population growth, supply chain optimisation, and ongoing e-commerce penetration particularly across Sydney and Melbourne corridors. With regard to the highest and best use, in parallel, industrial land and buildings are increasingly becoming evaluated through the highest and best use. For example, as noted in one of the recent articles, BlueScope Steel's Port Kembla site has now been rezoned to allow for a broader range of industry uses. Similarly, our industrial clients are also reviewing their own land holdings to unlock value and maximise returns by identifying the highest and best use. Alongside these logistics data centers and AI, there is also a growing trend towards adaptive reuse for leisure and recreation use, including pickleball and paddleball facilities, particularly in the secondary grade locations where traditional industrial demand is softer. This shift also reflects occupiers' willingness to repurpose functional industrial space to meet changing lifestyle needs. In terms of the market trends, I think as Gillian mentioned, the vacancy has increased slightly, but it still remains historically low compared to global standards. There has been an increase in vacancy in secondary or fringe markets, which gives tenants a selective leverage, particularly for mid-size or flexible space requirements. As I mentioned previously, the ESG and sustainability is now a consideration for the baseline requirement. It's no longer a differentiator especially for global occupiers. With regard to the market, it is currently a two-speed market, whereas modern, high-spec and well-located facilities are no longer staying on the market as long as secondary grade stock. Landlords of premium grade assets are commanding higher rents, whilst the owners of older grade stocks are facing limited rent growth and offering greater incentives to attract tenants. It's important for a tenant to understand this divergence and when positioning themselves strategically in the market and knowing how to use this as leverage. As mentioned previously, owners are also actively reviewing the industrial land, especially in the secondary grade market, in order to unlock value through the redevelopment or rezoning and understanding what is best use for that site. Moving on to the next one, as we've mentioned, in terms of the tenant's perspective, restructuring early allows you to unlock favorable terms whilst the market conditions are moderating, with higher incentives in the secondary grade stock and rent stabilizing. There is an opportunity for a tenant to negotiate a better deal now rather than waiting. The other one is premises due diligence. Knowing what to look for and negotiating a strategy that will allow you to secure terms that meet both your immediate and long-term operational needs that can be reviewed before or during the term of the lease. With the ever-changing ESG policies increasing sustainability requirements, the due diligence will help you identify potential compliance risks and kickstart a conversation with the landlord about an obligation for them to either uplift or try and maintain this standard.
Thanks, Ken. Now moving on to project services, where Rebecca will be taking us through circular fit-outs.
Hi, everyone. Thanks, Ed. If you go onto our website and click down on the drop-down menu, How We Help, you'll find a section containing our occupier guides, which cover a range of topics such as fit-out costs, premises due diligence, and the advantages and disadvantages of a design and construct delivery model. The purpose of our occupier guides is to inform tenants and provide practical, easy-to-use tool questionnaires. If you go to the second page, Ed. Today, I thought I would take a couple of minutes to talk about circular fit-outs, which we cover off in one of our occupier guides, and why they matter for every organisation thinking about the future of their workplace. The traditional office fit-outs generate a surprising amount of waste and embodied carbon. Materials are extracted, manufactured, and used for a few years, depending on the life of the lease. It could be anywhere from 5 to 10, and then often sent to landfill. A circular fit-out flips that model. Instead of a linear take, make, and waste approach, we design workplaces that keep materials in use for as long as possible. A circular fit-out focuses on 3 core ideas: reuse, adaptability, and responsible material choices. That means reusing existing furniture, partitions, and finishes wherever possible, selecting modular and demountable systems that can evolve with your business, and choosing low carbon, certified, and recyclable materials that reduce environmental impact from day one. What makes this powerful is it's not just good for the planet, it's practical. Circular fit outs help organisations meet ESG commitments, reduce long-term costs, and streamline approvals as green leasing becomes more common. They also create workplaces that people and employees feel proud of to be a part of, which is increasingly important for engagement and culture. To make circularity real, we break it down across the project lifestyle. In planning, we audit what can be reused and set clear sustainability KPIs. In design, we specify modular systems and materials with recycled content. During construction, we track waste, maximise recycling, and ensure materials are segregated properly. And once the space is occupied, we maintain an asset register so future refurbishments can continue the cycle. Ultimately, circular fit-outs are about future-proofing, designing spaces that are flexible, lower impact, and ready to adapt as your organisation evolves. The choices we make today genuinely shape the environmental footprint of tomorrow. And at LPC, we're helping clients turn those choices into real workable outcomes. Thanks, Ed.
Thanks, Rebecca. We've got about 2 minutes to go, and so we'll just get a couple of questions that have come through. Please feel free to ask away as well in the chat function. So this one's from me. So one of the LPC strategies for tenants is side deed variations at the edges. Can one of the panelists please expand on this strategy and how we sort of utilize it? Ken?
Yep, that's all right. Look, apart from focusing on the main items in terms of the incentives, rent reviews, when we talk about negotiating around the edges, we're also talking about other things that may affect your tenancy during the lease, whether it's obligations on landlords to maintain a ESG or Green Star rating during the term of lease, and if they do fail to do so, what are the implications or what are the penalties for the landlord? Others could include expansion, contraction rights, early termination rights. So there are a couple of examples negotiating around the edges.
I guess another one, Ken, is when you move into a A-grade building or something and it has the end of trip facilities, the third space meeting rooms, you're expecting them to be available for the whole time you're in the lease. And if the landlord either takes them away, you can sort of say you're in breach of the lease and potentially get some protections from that. I think that's also part of our strategies to negotiate around the side.
Yeah, correct.
So ESG has been touched on throughout the session in pretty much all sectors, including fit outs. How can we protect tenants with ESG protections in the longer lease term? So how can we kind of get that in the lease?
Yep, it's by negotiating minimum requirements that the landlord has to achieve during the term of lease. Again, the same principle. If those requirements are not met, what are the penalties for the landlord? Is there a rent abatement, or can the tenant undertake those upgrades on the landlord's behalf, and the landlord is responsible for those costs? There's a few different ways that it can actually be structured.
And can I just add to that? That
Yep.
On new developments, they will advertise the ESG criteria they are seeking or they're seeking to meet, but you won't have the actual data for what they're achieving until they've occupied the space and they've been able to log the data, for instance, with neighbours, and then confirm what their neighbours' ratings are. So what is advertised may not, this is particularly in new buildings, it has not actually been rated until they've been occupants for 12 months, and we're able to actually take that data and they're able to verify that they're achieving the rating they were aiming for. So it's in existing developments, the issue is, if the ratings change and they no longer meet the newer criteria, in new developments, it's actually in the first instance achieving that criteria once the building's been occupied for 12 months.
And I know, Rebecca, what we've done for tenants in that circumstance is the landlord hasn't achieved those ratings that they've proposed before their development, we've required them to purchase offsets to ensure that our tenants can still achieve those targets.
Right, there's one more question in. Yeah.
Yep. So where do the panelists anticipate to see the first rebalancing of office spaces to a more balanced or landlord-friendly environment? Should tenants attempt to restructure or renegotiate leases as soon as possible? Graham, I think you sort of touched on that.
I mean, we've seen from the data now that the vacancy rates, albeit very small movements, have gone. The only markets that have actually decreased were Perth and Canberra. I'm being based in WA. I know there's absolutely no supply due to enter the market or under construction now, which means we're really facing probably a minimum 4 years before a new building could be delivered, even if it starts in the next 6 months. So that's one market I think that is going to move quickly. I know the transactions that happened towards the end of last year are significant. There is a number of major deals that are very close to being finalised that will impact on those vacancy figures and therefore drive or enable the owners to start to push those rents. So I think that's one that'll move pretty quickly. I think we're already seeing it in other markets, but it can be in certain sectors. The eastern end of or Paris end in Melbourne is a lot tighter than, say, the Docklands end. So you might start to see that movement in that part of the market. You'll see it in grades where premium might be the one that's really moving quickly. So it does change market by market, but I think Perth will be one. Canberra fluctuates, and I think probably Sydney will be the next one.
Correct. Like similarly in Sydney, like we've got new supply coming online in 2027 or late 2027. There's only 2 buildings, and those buildings have about, I think, 50% pre-committed. The next supply that's due to come online is probably the Overstation Metro developments. So that's not in until 2033. So in terms of premium grade stock, there's probably going to be a bit of a lull I'd probably say between 2028 and early 2032. Like we're already starting to see the premium end of the CBD, the financial core tighten. Look, there are still opportunities out there, but you'll probably notice that the landlords are, I think, like you were saying, Graham, they're trying to push rents. So the effective rent is actually getting a little bit lower, but the incentive levels are still staying relatively stable.
And it's the same in Melbourne. There are a couple of new developments, but they're probably not in the prime areas of Melbourne, so they're not the take up is not fantastic. And then there is, similar to Sydney, there's a lull in development until early sort of 2030. So still a while for the Melbourne market to really move towards a more landlord friendly environment.
Yeah, I think the other question is, should tenants attempt to restructure or negotiate leases as soon as possible? Our view is time is leverage. The more time you have, the more likely you'll receive more favourable terms.
Perfect. Thanks, everyone. We'll run over time, so we'll quickly wrap it up. Thanks, everyone of our panelists and all you attending. Join us next time for our update on the Q1 status of 2026, and that will be on May the 7th at the same time as today. Thank you all.
Thanks, everyone.
Talk soon.
Thanks.